Legacy media is telling us lies about investing. They tell us, for example, that interest rates have a big impact on asset prices. But is that really true? What theories can we believe and which ones are just a distraction? What we see at the top, that's the gold price relative to the US money supply. And what we see at the bottom, that's the target interest rate by the Federal Reserve. The story goes like this. When the government is willing to pay a lot of interest on their bonds, gold as an alternative risk of investment becomes less attractive and is getting sold. When the government pays less interest though, that's when gold becomes a viable alternative again. But is that really what's happening here? Interest rates have been steadily climbing up at the end of the 1970s, and at the same time the gold price shot up as well. When interest rates fell, the gold price also went down. What about the recent past? There seems to be no connection. There's monetary tightening and so interest rates are going up. Yet during the same time period the gold price went up. Subsequently there was monetary easing. Still the gold price went up. Then we had a prolonged period of close to zero interest rates. Sometimes gold went up, sometimes gold went down. This narrative that investors are shifting between one risk of asset and the other risk of asset based on the interest rates that are set by the Federal Reserve, I'm not sure if it really holds. If I'm constructing a portfolio based on a theory, I at least want to see how that theory partially worked in the past. If the connection between my indicator and the price development is that loose, does it really make sense to use that indicator? So for the gold market and the theory of investors moving from bonds to gold and from gold to bonds based on the interest rates, we can already clearly say that that theory does not hold over time. But what about the stock market? At the top, we've got the S&P 500. Here, this is the top at the dot-com boom. Then we had the dot-com bust, subsequently the global financial crisis. Bitcoin was created over here, so it only saw periods of appreciating risk on assets. But this is not the point. We want to see how much stocks correlate with interest rates. So the media tries to sell us the idea that there is a movement between bonds and stocks based on the interest rate. When the interest rate is very high, when the risk-free rate is high, then it's less attractive to own stocks, and then stocks should go down in price. When the interest rate is very low, then stocks should appreciate because holding bonds is not attractive. Now that's the theory. But does it hold? We had monetary tightening up until the beginning of the 1980s, and stocks indeed fell. Then we had a long stretch of falling interest rates, and stocks outperformed monetary debasement. Now that connection is extremely loose though. Let's zoom in. Here we've got monetary tightening. That's over the course of 3 years, yet stocks slightly appreciated. Then we had monetary easing. Stocks barely moved. Monetary tightening. Stocks again barely moved. And then a rate at around 6%, while stocks continued to appreciate. And then money got very cheap, yet this did not help stock prices. Money got expensive again, stock prices slightly appreciated, etc. We can see there's not really a clear connection here. Now the question is always, is this just a reaction? As in the Federal Reserve is reducing rates because it sees dangers in the economy? Or is the connection simply not that strong? Because we did have rising prices during loose monetary policy, but then once we tightened up again, this barely had any impact on stocks, right? We went from 0% to 5.5%, and stocks didn't really move much, as in there was no big sell-off in the stock market and everybody suddenly moving into bonds for those higher yields. There's also this other idea of discounted future cash flows, as in the higher the interest rate is, the more we have to discount future cash flows, thus prices should come down. So whenever we have rising interest rates or the expectation of rising interest rates, then anything that pays a cash flow in the future should go down in price. Property should go down, stocks should go down, and the alternatives like gold might actually appreciate from it. But again, we don't really see that connection. It's not really clear that the theory holds holds in practice. To me, it's at least clear that I don't want to trade the top chart based on the information at the bottom. Now, the interest rate is connected to something though, and that is the inflation rate. At the top, we've got the officially measured CPI, the Consumer Price Index change. At the bottom, we've got the interest rate. And yes, of course, when there is high inflation, interest rates are high. When there's low inflation, interest rates tend to be low. We can also calculate the delta. That's over here, the interest rate minus the officially measured inflation rate, also called the real interest. In red, we see the zero line. So everything above red pays us real return in terms of purchasing power. Everything below that, that's removing our purchasing power. In other words, if we hold bonds, we would get less purchasing power going forward. Now, since 1971, we had on average positive real interest of roughly 1% per annum. Now, that's not much, but for taking on zero risk, I guess that's acceptable if you at least believe in the CPI numbers. I don't, but you might. What I find more interesting about this chart though, is that there seem to be two phases. The first phase, where we tended to have positive interest rates up until here, and a second phase where we tended to have negative real interest rates. So 2001 seems to be the turnaround. If we plot the chart since then, the real interest rate on government bonds was minus 0.64%. So owning bonds burned purchasing power, even measured in consumer goods that should in theory become easier and easier to produce over time, right? We've got technological progress. And so I think it's those kind of developments together with capital concentration that lead investors into more and more risk on assets. In the early days, it was popular to have a 60-40 portfolio. 60% stocks, 40% bonds. Now quietly, the bonds moved away, as in the bonds were not attractive anymore. Then people moved mainly into stocks. And now it's much more popular to own mainly tech stocks, a bit of regular stocks, and maybe also some cryptocurrency. So the more capital concentrates and the harder it is to produce real income, the more the average market participant is forced to gamble with their money, the more risk is being taken. And so that really begs the question, should we follow the news that closely? Is it really that important where the interest rate is going? Should we discuss who the Federal Reserve chairman is? Does it really matter that much to us if you don't have a huge mortgage portfolio or if you don't have a business that's dependent on people borrowing money? Let's say you work in a car dealership. If something is connected directly to the financing rates, then of course the interest rates matter. But outside of that, for the regular valuation of gold, of stocks, etc., it really doesn't matter. I think it's mainly noise. That's at least what the data suggests. I don't want to trade the top chart based on the interest rate chart here at the bottom. It creates terrible signals. Down below, there is a link for this cheat sheet over here. How to see the big picture, how money flows from one asset class to the next. It's completely free. You can get it either via Telegram by scanning this code or by clicking the button on the website. Again, in the pinned comment down below. You can also plug in your email address over here. No payment is required, no credit card is required. It's completely free. Feel free to check it out. If it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time. Cheers.